Chapter 22, Profit Sharing Plan. What is it? A tax-qualified, defined contribution plan featuring a flexible employer contribution provision. Contribution can be purely discretionary amount or based on some type of formula. Employer contributions allocated to individual accounts of participants on a non-discriminatory basis. Plan benefits consist of the amount accumulated in each participant's account at retirement or termination. When is it used? When employers' profit vary from year to year, this may be the most important feature. When employer wants an incentive feature, and when employer wants to supplement an existing benefit plan. Maximum contribution flexibility for the employer is the biggest advantage. Contributions can be made even if no profits. It provides a tax-deferred retirement savings medium for employees, simple, inexpensive plan, tax-deductible for employers, and tax-deferred for employees. Some disadvantages: retirement benefits may be inadequate for older employees entering the plan. Relative amount of plan funding available for highly compensated employees is more limited, and the employees bear investment risk under the plan. Level of employer funding is less predictable. Some alternatives: a money purchase pension plan, where the employer is required to make contribution, cross-tested, age-weighted, and target benefit plans, favorable for older employees. Defined benefit plans provide more security, but they're more complex, and the employer assumes the investment risk. Non-qualified deferred compensation plans, executives and highly compensated employees. Individual retirement savings, little or no tax benefit. Design features: the employer contribution arrangements. The employer contributions are based on discretionary provision. The employer decides if, when, and how much to contribute. And a non-discretionary formula. The employer must contribute the amount or percentage annually. There are allocation to the participant accounts. All plans must have formula for allocating employer contributions to participant accounts. Cannot discriminate in favor of highly compensated employees. Compensation must be defined in a non-discriminatory way. The amount of compensation taken into account is limited, and it can be based on compensation or years in services, may be integrated with Social Security. Vesting. Generally, vesting provisions permitted by code can be used. Many use 2 to 6 year vesting provisions. Forfeitures, the non-vested amounts forfeited upon leaving early, reduces employer contributions, pay plan expenses, contributed to participants' accounts. Formula for allocating forfeiture is usually the same as that used for allocating the employer contributions. Distributions: benefits usually payable at termination of employment, death, permanent disability, or retirement. Payable in a lump sum or series of installment payments. In-service distributions: benefits payable for hardship or age 59 and a half before termination of service. 10% early distribution penalty may apply to distributions prior to age 59 and 1/2. And loan provisions permits loans without early distribution penalty. The investments: pool account managed by the employer, or a trust fund or group or individual insurance contracts can be used. Participant invested account: there are a limited number of possible investments to reduce administration costs. Participants direct investments and take responsibility. The employer or plan fiduciary responsible for selecting and monitoring investment options. ERISA requirements, subject to ERISA reporting and disclosure rules. Tax implications for employers: the employer contribution is deductible when made. The maximum deductible employer contribution may not exceed 25% of the payroll of all covered employees. If the employer also has a defined benefit plan covering some of the same employees, the deductible contribution is limited, and some employers are eligible for a business tax credit. For employees, taxation deferred until amounts withdrawn. Annual additions are limited to the lesser of 100% of employee compensation, or $53,000 here in 2015. In 2019, it is $56,000 plus the $6,000 catch-up contribution for those over 50 years of age. Annual additions include the employer contributions, forfeitures allocated to participants' accounts, and the employee contribution. Social Security integration. Standalone plan may be integrated with Social Security. Employer costs are reduced. Employer contribution disproportionately allocated to higher paid employees. Integrate defined contribution plans by contributing at a higher rate for compensation above certain earnings, the excess contribution percentage. Maximum difference between the excess contribution percentage and the base contribution percentage depends on the earnings level, the integration level. Integration level can be taxable wage base used for Social Security purposes. In defined contribution plan, integration level can't be higher than the taxable wage base. Choosing the integration level, most want it to be just above the compensation level of the highest paid non-owner employee, and choosing an optimum integration level is complicated. It might or might not increase the owner's benefit. Purchases of life insurance. Participants can direct the plan trustee to purchase life insurance on the life of a person in whom participant has an insurable interest. The plan must permit directed investment. The plan must permit the purchase of life insurance and the amount governed by incidental limits. PTE 92-6 requirements. The sale must be to a participant, a relative of the participant who is a beneficiary under the contract, an employer, or certain other employee benefit plans. The plan, but for the sale, would surrender the contract. Also, the insured participant must be given an opportunity to purchase the contract first. The purchase price must put the plan in the same cash position as if it had retained the contract, surrendered it, and distributed the participant's vested interest in the plan, and includes second-to-die policy on participant and spouse.